The S&P 500 is selling off over the last week. We have stocks like Nvidia down almost 8%, Apple down almost 4%, and Tesla down nearly 10%. And then of course we have murmurings of more tariffs on the way. And of course the S&P 500 is actually trading at its most expensive valuation since the dot-com bubble. And while we can see some areas where the market actually is green, such as healthcare and consumer defensive, we have to keep in mind these tech stocks make up the vast majority of the S&P 500. For example, if we look at just the Mag 7 stocks, we can see at the end of 2024, the Mag 7 stocks made up 35.4% of the entire S&P 500. So a sell-off of tech stocks would undoubtedly push the market lower. And in fact, after the recent sell-off over the last week, we can see the S&P 500 is now down about 1% in 2025. And if we look at the CNN Fear Greed Index, which basically measures market sentiment, we can see we are in extreme fear right now. Now, typically, anytime we have a 1 week or a 1 month sell-off, people will start claiming that a bear market is on the way. And that could be the case. I honestly don't know over the short term, and anyone who says they do know is either in Congress or is lying to you. But when it comes to bear markets, there are two very important concepts you have to make sure you understand. Now, this first concept we have to understand is what's known as sequence risk. And basically, this is the risk that an investor will experience negative portfolio returns very late in their working lives and or early in retirement. And sequence risk is a significant threat to retirees. Let me show you why and how we can completely eliminate this risk. Let's look at an example with two different investors. Investor number one retires at the beginning of an up market, a bull market, and then investor number two retires at the beginning of a down market or a bear market. Now, in this example, we can actually see both investors had an average return of 4%. See, right here. So it was the exact same average, but their sequence of returns was quite different. Investor number one had positive returns for the first few years of their retirement, while investor number two had negative returns for the first few years of their retirement. And look at how stark the difference is. They both had an investment value of $100,000 to start in year zero. And at the end of 15 years, investor number one had about $106,000, while investor number two had about $35,000 to $36,000, all while averaging the same returns. This goes to show you how important the sequence of the returns you get can be. So if we look at this visualized, we can see the returns the investor number one gets throughout retirement and the returns investor number two gets throughout retirement. So clearly, sequence risk is a very real thing, and it's very dangerous. So how do we eliminate sequence risk? I mean, just think of the people who wanted to retire during the dot-com bubble, during the global financial crisis, or even during 2022 when the markets dropped by about 20%. The ability for those groups of people to retire were greatly diminished. But here's the answer for eliminating sequence risk. It's using dividend income to retire. And not only using dividend income, but buying quality dividend growth stocks. Let me show you what I mean. If we're on Seeking Alpha, let's take a look at Microsoft Corporation. If we take a look over the past year, they're down about 6.5%, but we're not as concerned over the past year. Look at it over the past decade. Now, we're not really paying attention to the price return, and I'll show you why in a moment. Now, throughout the past decade, yes, the returns are very good, but pay close attention to the drawdowns they saw over the past decade. For example, in 2020, they were trading about $185 per share, then dropped all the way down into the lower 130s. If we look in 2022, the stock was trading as high as around $340 per share and dropped all the way down to around $240 or even $230 per share. That was a pretty large decline of almost 30%, and we can see it took about a year and a half for the company to recover. So even in this quick example with Microsoft, you can see why sequence risk would come into play for investors. But what if you're using a dividend growth strategy? Well, what we can see with Microsoft is even in those years where the company saw large declines of 20 or even 30%, they were increasing their dividends every single year. So what does this mean? Well, if you're buying quality dividend growth stocks that increase their dividends every single year and you're using that as a strategy to retire, then you don't have to worry about sequence risk. You don't have to worry about what's going on in the market. Your ability to retire is completely detached from what's going on in the market. And there's plenty of other examples of this. In fact, if we just look at the S&P 500 over the past decade, we can see those dividend payments are growing every single year, and this isn't even a dividend growth focused ETF. For example, if we look at SCHD and look at the past decade for this dividend growth stock, we can see the dividend payments have grown at a very high rate. So when you're building out a recession-proof dividend growth portfolio, it becomes clear how to eliminate sequence risk. So this brings us to point number 2. We understand how dividend growth can allow us to eliminate sequence risk. We no longer have to worry about market fluctuations. But with that being said, how can we take advantage of market sell-offs? And this is where a lot of people make a mistake. And I was actually recently talking about this on Twitter. There is a huge difference in high quality stocks versus low quality stocks during a bear market or even just a market sell-off. In both situations, the share price is going to fall in a bear market. So high quality stock sell-off and low quality stock sell-off. But this means the market isn't intelligently selling stocks off. For high quality companies, the underlying fundamentals don't necessarily deteriorate during a bear market. But for low quality companies, fundamentals often do deteriorate during a bear market. So what does this mean a bear market does for us? Well, what it does is it creates opportunity to buy high quality stocks at better valuation, but it also creates the illusion of opportunity to buy lower quality companies. There are many low quality companies that never fully recover from bear markets. Meanwhile, buying high quality companies during bear markets can often lead to amazing results. So how do we know the difference in high quality versus low quality companies during bear markets? And it's actually quite simple. You have to pay attention to the underlying fundamentals of the stock. So let's take a moment and look at an example. Jump over to my stock screener. Let's use Microsoft as an example again. We'll come up here and plug in MSFT. All the data will load in. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, when we look at the underlying fundamentals for Microsoft, what do we see? Well, look at revenue per share over the past decade. Nearly every single year, we can see pretty significant growth in the top lines, revenue per share. Look at earnings per share. The same for the most part is true. We see a little bit of fluctuation, but there's obviously significant growth. Look at free cash flow per share. The company is generating more and more free cash flow on a per share basis every single year. And if we look at the profitability of the company, just look at how revenue has exploded over the past year. We can see the gross profit ratio has not only stayed steady, but it's actually increased. Last year's came in at close to 70%, when the 10-year average was about 67%. So regardless of how the share price has been moving over the past 5 to 10 years, this company is growing earnings, it's growing revenue, it's becoming more profitable. We're seeing all the signs of a high quality stock. So again, the key highlight is the fundamentals continue to grow, but the opposite is true of low quality stocks. When their share price drops, oftentimes so do the fundamentals. And this is where they can get in danger, because if we see the balance sheet start to deteriorate, that's where it really starts to become a difficult problem for the company. So yes, a market sell-off does give opportunities, but there's also illusions of opportunities. We have to ask ourselves, are we looking at a high quality stock or a low quality stock? Because that'll tell us, are we looking at an opportunity or an illusion of opportunity? So yes, we are seeing the market sell off right now, and who knows, maybe the S&P 500 in 2025 will end up in the red. I personally have no idea. Again, in reality, nobody does. But because I'm buying high quality dividend growth stocks, I'm ready to take advantage of bear markets, and I don't have to worry about sequence risk either. My portfolio's dropped over $4,000 in just the past day or two. But I know that's nothing I need to be concerned about. In fact, a market sell-off also means that stocks that I buy will end up having a higher starting dividend yield, meaning when I buy them, I'm going to be receiving more in dividend income. In reality, if you're a long-term dividend growth investor, there's almost no reason to be concerned about a bear market. There's really only positives to take from it. But go ahead and let me know in the comments down below what opportunities you plan on taking advantage of. I think there's plenty of quality stocks that are starting to become quite a bit more attractive. Again, like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.